1031 exchanges. I'm going to let you take it away and kind of give us an overview of what all the things and walk us through the information that you think is important for people to understand and what they need to know.
Perfect. Well, first of all, thank you for that introduction. I do appreciate all the referrals, and I'm happy to help your clients whenever the need arises. And it's so true, first of all, that I think clients get misinformed for two reasons. First of all, they don't know enough about it, and they try to seek the advice from a realtor, and the realtor might know a little bit of information, but not all of it. And that's okay. But they also might go to their accountant and ask questions about from the accountant. And honestly, a lot of accountants don't know the ins and outs of 1031 exchanges. And so I think it's really important that you have a really good team. A team being like a great lender, a great realtor, they call me a qualified intermediary, a great accountant who can help you navigate the real estate world. I feel like a lot of people are so honed in on just their products, their forms, that they kind of miss the big picture. So I think it's important to shop around to get that really good team that will help you reach your financial goals. So that's my 2 cents.
Yeah, 100%. And I will resonate everything you just said. It's people think they know and they don't know. I was talking to a friend the other day and they're like, yeah, my accountant said da da da. And I was like, I'm not a licensed CPA. I don't know enough, but I know enough to be dangerous. I would potentially question that, be curious about that, or get a second opinion.
It's so true. It's like, I know enough financial advice to make me dangerous, but that's not my role. Like, I can't wear that hat when I'm your qualified intermediary. So it's very important that they get the proper information.
Yeah. So you have been doing this. So give us a little background on your career and just talk us through some of your background and why you are where you are today.
Yeah, I mean, really, my career started 20 years ago. So I was outside of college looking for a job, and I majored in marine biology. I mean, my background is science. I mean, you couldn't get further from it than doing this. But it was my first job was working inside of a law firm. And so they had a division that did 1031 exchanges. And I found it so fascinating about how there's so many avenues and so many different connections within the real estate industry. I mean, you get to know escrow or title. You get to work with other attorneys, the whole lending division. So I found it really fascinating. And the most fascinating part was just how many different ways you can put a 1031 exchange together. I just found like you're constantly learning. And for me, I love constantly learning versus being stagnant in something that becomes just routine. So that's kind of why, and I've dabbled in other things. So when the recession hit, I wasn't doing exchanges, I was doing other things, but I found myself in the real estate world. So I tried to sell real estate, and I loved putting the deal together. I love the strategy behind that, but the rest I could leave it. So so then I found that it was drawing me back in. There was no other local competition besides when I did it. And so I was like, the pull is there, the need is there. I'm going to get back in it. I'm going to do it. So that's where I am today. I own my own company. I'm in Southern California, but because it's part of a federal statute, I can work nationwide. And as you probably can tell, I'm really passionate about it. I still find it really interesting. And there are cases that come across my desk where I'm like, I'm gonna get a legal opinion on this because I don't really know how we should structure the deal. I mean, I'm still constantly learning, and so that's me. That's my.
It's interesting that you say that, Megan, because I always say that, from a financing perspective, I'm like, people think it's just like, oh, my credit and my job and my assets. I'm like, really, truly, your financing is kind of as unique as your DNA, as your fingerprint. And I think from an exchange perspective too, I know you can attest this in the stories you've told me and things we've talked about, is sometimes an exchange can be as complex as the individuals in the transaction, as their DNA. And so when you say you're constantly learning, I do the same thing on my side. It's not black and white. There's a lot of areas, it's not black and white for each person. Like everything is a little bit unique to that individual or to the transaction.
Right. And I feel that more people are getting savvy on how they get into real estate and structure their deals. And so more people are becoming aware, like, I shouldn't have it just in my own name. I should probably have it in a trust or an LLC so that it protects me from the tenants. But then there's layers to that. Like, was that formed in a community property state or a non-community property state? Because it makes a difference in your 1031 exchange. I mean, there's all these, then you get into all these little nuances that could make a difference and complicate the transaction. So
I agree. It is interesting. Okay, so tell us what an exchange is. What's an exchange?
So first of all, an exchange has been around for over 100 years, and it's part of the federal tax code. And it's section 1031 within the Internal Revenue Code. That's what we're talking about here. And over the last 100 years, I would say overall 1031 exchanges and the components of the exchange really haven't changed all that much. I think a better way to look at it is that things have been more defined. So instead of there being a lot of gray areas, which there used to be 20 years ago, I think a lot of those gray areas are less gray. They're more black and white. But for those of you who don't know, a 1031 exchange allows real estate investors to defer paying capital gains tax on the sale of that investment property, as long as they're reinvesting those monies into another type of investment property that's like kind. And like kind is, yeah, that's the key phrase in the 1031 code, is like kind. Like, what does that mean? How is that defined? And it's the next slide. I don't know if you want to.
Yep. My computer is being slow. There you go.
So like kind, or you might have heard the term like for like. 100% the most misconstrued term within the 1031 exchange conversation. I think that most people misinterpret what that means. I think that most people, the mom and pops, many realtors, they interpret that to mean if they're exchanging a condo, they must buy a condo, or if they're exchanging a house, they must exchange into a house. And that's not what you should interpret it to be. Like kind, or like for like, is simply an investment property for an investment property. But an investment property comes in many forms. Not all of them qualify for real estate purposes, but we're mainly talking about real estate investment properties, something that's held for investment purposes or business purposes. That's what we're talking about here. So you can exchange a condo into a house and vice versa. But I think it's important to really hone in and define what does qualify versus what doesn't qualify, because some real estate assets definitely do not qualify for 1031 exchanges. So when we're talking about the 1031 exchange, we're definitely talking about your single family residences, your condos, your houses. It doesn't matter if it's a short-term tenant or a long-term tenant. What matters in the exchange is how you report the property. Are you reporting the property for investment purposes? If the answer is yes, then more than likely it qualifies. If the answer is no, not really, it's more of like a second home, then that's not going to qualify. It's immediately going to raise a red flag. And if you try to do an exchange with that property, it's probably going to be overturned. Right. You also have your multi-units. So what I find interesting is that people will buy a duplex or a triplex, and some of them will try to house hack. So they'll live in one of the units and rent out the others, and those rental components can pay their mortgage off the whole asset. Well, if you're trying to sell the property, the parts that you rented, let's just say if it's a duplex, the 50% of that unit that is rented is exchangeable. The other part is a primary residence. So if you were to sell that asset, you could technically do an exchange on 50% of that asset. The other 50%, you get your primary residence exclusion. And so that is an interesting component and a fun way, but an interesting way that you can structure your 1031 exchange. And I don't think a lot of people consider that or think of that.
I actually because what you're doing is you're saving tons of taxable consequences, number one, but also you can divide that initial asset into two potential purchases from my perspective. So you can take that 50% and then go buy, you know, a multi-unit that actually, that is only a investment property and, you know, get income off of those units, right? So it's a income stream, and then you can go buy your primary residence. So I think it is fun. In my world as a nerd, it's super fun because you get to build wealth. That's how people do this. And many people don't understand that. So
yeah, agree 100%. Back to the list, vacant land, of course, that's not income producing, but most people are holding on to it. And I find that most people are holding on to it to eventually develop on it. So therefore, that definitely qualifies for a 1031 exchange. Of course, farmland, that's income producing, that qualifies for an exchange treatment if you want to exchange out of it or exchange into it. And commercial real estate, I find that I'm going to say most mom and pop investors don't realize how affordable commercial real estate assets can be. And so there are commercial standalone properties where you can buy the whole investment if you can afford it. And we're talking about like a fast food establishment. You can buy that building if you have $1 million or so to do that. Well, a lot of mom and pop investors don't. And what they probably don't realize is that a lot of these commercial real estate deals can be broken into pieces. And so you can buy an undivided interest in an asset with other investors where you're all tenants in common on that property. You get a deed to the property, you get a percentage of ownership, you have a say in how it's managed. And they're affordable. So some of them might have a minimum of only $100,000, and that definitely can satisfy an exchange and allow you to branch out from always residential into something that is commercial but passive right. Income.
Yeah, that's it. Good. Keep going. We have a question, so but I see it. I'll get to your question, Andrew, in just a second.
And then you have other types of commercial real estate assets that are in the securitized world. So think of it with your financial broker. And so there are it's called DSTs, but it stands for Delaware Statutory Trusts. And it's in the commercial real estate space. But think of it where there is a corporation or a company that comes in and it buys a portfolio of real estate assets, but they do that underneath a trust, and they do it underneath a Delaware statutory trust because that state offers the most protection for that corporation to separate itself from the investors and the tenants of the property. So that's why they're using the name, because that's how they're all pretty much structured, just for that component. As the trust owns this asset, you as an investor can buy into it as a beneficiary. So you get a beneficial interest within the trust, and the benefit are the assets that's underneath the trust ownership. And so you don't get a deed to the property per se, but you get monthly income, monthly distribution. It's passive income to you. Your hands are pretty much tied when you go into the DST space. So it's not for everybody, but at least it qualifies for a 1031 exchange. And the reason that I mention it is because a lot of people, especially in the real estate market where inventory is very limited, these DSTs are all over the United States. So you can easily identify, and get a piece of the pie that will satisfy your 1031 exchange. It satisfies your cash requirement and it satisfies your debt requirement. So the way that works is that most of these assets already have the financing in place, and the sponsor, the trust, allows you to assume a portion of that financing so that it meets your debt requirement. So you don't have to go out and obtain a new loan. You can just get something that's assumable and it meets your exchange. So not for everybody, especially because it's securitized. You have to be an accredited investor and even to look at these properties, which means that you have to have a net worth of at least $1 million, excluding your primary residence. So that definitely puts a lot of people out of that category. But for those where they meet that minimum requirement, that it's an option for a 1031 exchange, and it's worth mentioning. So
especially in the inventory, yeah, from a protection perspective. So you just, yes.
Yeah, and a lot of people will like if they have debt left over in their exchange, they'll use a DST to shelter that component. Mm-hmm. So they don't have to, they can basically, they can do these lopsided loan to values into these DST spaces, and you can't do that anywhere else. Right. So And then another thing that again, worth mentioning, because it's not tangible, it's oil and mineral rights. So even though it's not tangible assets, there's value to that and it's exchangeable. Not as common, but it's doable. Let's just talk about what doesn't qualify. Like I mentioned before, your primary residence, that is excluded. That has its own exclusion, section 121 of the tax code. And you get your own exclusion automatically at that sale, as long as you've lived in your property 2 of the last 5 years. So single people, you can defer up to $250,000. Or if you're married, up to $500,000. So a lot of people with their primary residence, they don't even need to, a lot of them will call me and say, hey, I want to do an exchange with this property, but I live in it. Well, you can't, because it's your primary residence, but you might not need to like even consider it anyways, because you're deferring the gain on your primary residence just by selling it alone. So property held for resale, we're talking about properties that were recently flipped. So acquired quickly, turned around and flipped. That doesn't qualify because that is not an investment property. That is like, or the owner, the investor, you're not a long-term investor. You are considered a dealer of real estate. So you don't qualify, nor does the property qualify for a 1031 exchange. Vacation homes, where if it's primarily used for personal use, it doesn't qualify. So if it's your second home, you're always using it, that doesn't qualify for an exchange. What qualifies is if you have a property, I'm going to use it like an Airbnb property, for example. If you use that sometime throughout the year and you rent it, that can qualify. First of all, you want to make sure that you're not using the property for personal use longer than 2 weeks out of the year. Or if you know how much it's going, at the projected amount of time, if you know that information, you can use it 10% of that allotted rental time. So if you have it in your Airbnb and you know it's going to be rented for 200 days, you can use that for 20 days out of the year, because it's 10% of that allotted rental time, whichever is greater. So the minimum time you can use is 2 weeks. The greatest is that 10%. Stocks, bonds, mutual funds, not real estate, doesn't qualify, even though they're investments, it's different. And then REITs are securitized, but the way that they're structured, they do not qualify for 1031 exchanges. There are products out there that you may have heard of that are called 721 up REITs. Those qualify, but how they're structured is unique. And so basically you would be doing an exchange into a structure that's like a DST. And so they hold your funds, your exchange funds go into the DST, you get the beneficial interest, and it's within that structure for 2 years so that it's satisfying your 1031 exchange requirement of holding on to an investment. So it's long-term. So it meets that requirement. And then that asset gets converted into a REIT. But the kicker is that this is the end all with your exchange. So if you exchanged into the REIT and you decide to get out of it, you cannot do a 1031 exchange outside of that REIT. You have to sell your shares and cash out, and it becomes taxable to you. So most of the older clientele that I have, that they just want that they're done with exchanging, they just want the money sitting in the asset so that they can use it for retirement, what have you. A lot of them will invest into this 721 up REIT, knowing that they cannot get out of it through an exchange.
Yeah. Okay, that's good. Let me go to my question really fast here from Andrew. He says, let's say an investor started with a duplex and 1031 exchanged their way up to an apartment building while using cost segregation and accelerated depreciation over 10 years. What consequences would they experience if at the 10-year mark they decided they would like to sell their real estate? Is it just a capital gain, or is there some depreciation recapture? Anything else that should be considered?
That's more of a tax advice question, because there's a lot more underlying layers that's really involved in that. So I can't get specific to the answers, but if they were after the 10-year mark selling that asset, then we're not talking about exchange. We're talking about a taxable event. And that's where they really need to have that conversation with the accountant to say, if we did cost segregation over that 10-year time, what does that look like if I were just to sell it versus to do another exchange? If they decided to do another exchange at that point, then you get to recapture that depreciation. So you get to reset that depreciation and start over with your new property that you're investing into. So I can't get too specific on that, but there is a tax liability. To what extent, you have to go over those numbers with the accountant.
Thank you. All right.
So I mentioned this earlier. So the benefit goes to the long-term investor. So you cannot be someone who is flipping real estate, and also you can't have your cake and eat it too. You have to look like you're a long-term investor. But I'll tell you that there's nothing absolute defined within the statute. So you get different interpretations from different legal advisors. Some of them say that as long as you hold on to the asset before you enter into an exchange and report it as an exchange, or report it as an investment property for at least a year, that suffices. That's good. That makes you look like you're an investor, not a dealer. Other advisors will be more conservative and say at least a minimum of 2 years before you exchange out of it. And then once you exchange into it, you want to make sure that your intention is clear. And that is what this all boils down to, is what is your intention? If your intention is to have your cake and eat it too, you're pretty much disqualifying yourself. So you want to make sure that your intention is to hold on to these assets, whether you're exchanging out of it or into it, for long term. So, and the way that the IRS can catch you on this is on the tax form. So there's a very specific tax form that they're filling out, and it's tax form 8824. And it's going to ask, the questions that it asks are very specific to your exchange transaction. And it's going to ask you, when did you initially acquire that relinquished property? The relinquished property is your sale property in the exchange. When did you initially acquire that? And what is the closing date of that, or the transfer date of that relinquished property for this exchange? If it's only a couple of months, you're raising a red flag. There's no way that that is going to fly. It's immediately going to be overturned or questioned, and you're going to have to explain why you did what you did. Now you can say, well, my intention, like I had this property and I was definitely going to hold it as a long-term investment, but I got this amazing offer and I definitely intend or bought a new replacement property that I absolutely am going to hold on to long-term. It's a much better property. It's going to bring me more income. It's a much better area, blah, blah, blah. That might uphold because your intention is being stated of why you did what you did. So it has to be clear about your intentions before you enter into the exchange and outside of the exchange once you enter into that new property. That sets you apart from somebody who looks like a dealer or a developer of assets where their intention definitely is to not hold on to the property for long term.
Interesting.
So most of my clients, they, first of all, I want to say that an exchange is not an all or nothing transaction. You can defer all of the capital gains tax or as much as you want to. It really depends on your financial situation with the properties at hand. I would say the majority of my clients, their number one goal is to not pay a dime in taxes with that particular exchange file. And if that's the case, then you want to make sure that you're crossing all your T's and dotting all your I's. And these requirements that I'm mentioning, they're absolute, right? So you have to follow these guidelines in order to have a successful exchange, whether it's a complete full exchange or even a partial exchange. And the first one is that you want to make sure that you're purchasing replacement property that is equal or greater in value than what it is that you sold. So if you sold a property for $250,000, you want to make sure that you're buying another replacement property for $250,000. That's first and foremost. If there was, or any of the proceeds that are netted, they're going to be held in a bank account that I have set aside for you. And all of those monies need to be reinvested into that replacement property, the $250,000 replacement property. If there was a loan that you paid off at the closing of that transaction, that amount needs to be replaced in that new replacement property. So you're basically taking your one scenario, you're recreating it or making it bigger. Mm-hmm. So that's the goal. That's what you're doing. If you go below that, you can do that. It just means that you're creating a taxable event on the difference, right? So if you're buying down in value, you're either not reinvesting all of your cash proceeds, or you're not taking on enough debt in the new property. So in either scenario, it's mortgage boot or cash boot, and the boot is taxable. That's always taxable first, dollar for dollar, up until you reach that full capital gains amount that you're trying to defer. So it's just something that you need to keep in mind, because some people will be like, I don't want to reinvest all of my money. I need some of that cash out. But you need to think that if I'm taking $50,000 out of the exchange, I'm pretty much going to be eating up about 30% of that in taxes. Is that okay for you? If that's okay, then you can do that. But most people don't want to do that. So those are the things that you really need to think about. When that sale property closes, the relinquished property closes, that date is what sets the tone for the exchange. So you create this exchange time clock. The first 45 days is called this identification period. You have to identify replacement property options within that first 45 days. And identification means one of two things. It means that you're either in contract on a property, or you're providing me a letter that lists the properties that you think you're going to write an offer on. So, or you've written an offer, but it's not a contractual binding obligation yet. So it's one of those two things that has to be done by day 45. And if it's not, you cannot continue on with your exchange. That means that your exchange is over on the 46th day, and all you have is a straight sale. You do not have an exchange. So it's important that you meet that requirement. If you've met that requirement, then you have an additional 135 days to fulfill the obligation of purchasing one of those properties or multiple properties that you identified. So your exchange total is 180 days. And so it's important to know that. But without that identification window, you can't move on, and you don't get the full 180 days. The last thing I want to mention, and this is an important one, is that throughout the exchange, once you're selling and once you're buying, it has to be the same taxpayer. So if you start off as husband and wife, you need to make sure that you're purchasing as husband and wife. If you start off as your sole and separate, you have to make sure that you're purchasing as your sole and separate. The complications arise when you have a partnership. So this comes up where I have a client who's like, oh yeah, well, I own it with a partner of mine. I'm going to do the exchange, but my partner isn't. Well, how are you a partnership? Are you under an LLC? Are you both members? Because if that's the case, you're joined at the hip. So that means that the partnership, if it's selling that property together, it has to buy another property together, which means that if that's not what your intention is, you need to figure out that before you get into a contract with a buyer. So that means that you need to hire an attorney to help you either dissolve the partnership or help you figure out a way where maybe you can bring in a new partner who's going to join you in that exchange of that asset so the other partner can cash out. So it's important that you know exactly how you hold title to that property. A lot of people don't. They're like, I think
crazy. It's crazy.
Yeah.
I don't mean to interrupt. I see it all the time. People are like, I don't know how to hold title of the property. I'm like,
yeah. Or that they're like, I think I deeded it. I think I deeded it to an LLC, but I'm not sure who's what members. So it's, you can always get a copy of your title report from the county or the copy of the deed. It's public information. So it's important that you have that information and know this before you even list your property. If you have the inclination that you're going to sell it, then I would say that you get all of your ducks in a row to know how you're going to move forward. It's important.
Super, super, super important. And sometimes I get into exchanges and I'm like, well, wait a second, the LLC entity sold it and there's only one person in the LLC, and now you want to move it in, now you're married and you're putting it into the same LLC, but you added somebody into that, like that also can create consequences.
Yeah, it's like your head just starts spinning.
Yes, it does. My head spins all the time. Okay, let's go.
So going back to the requirements, I think this is this we should really focus in on just for a few minutes. And there's 3 factors that you're looking at. And this comes from, when I'm looking at this, I'm looking at a closing statement. Usually it's an estimated closing statement, but eventually it's that final closing statement. You want to make sure that you're replacing the contractual sales price. It is that top line item, that's total consideration. That is the value that you need to replace in your exchange. However, you can deduct closing costs and certain certain closing costs and commissions from that value. And that's the true value that you're going to be replacing. So some people are really trying to go very specific from their sale directly into their purchase, and they want to keep this in mind. Like, okay, so I sold a property for $1 million, but I paid $20,000 in commissions. So now I only have to replace $980,000. Yet I paid another $5,000 or $6,000 in title fees and escrow charges. So now that drops it down. So that's what can be replaced. I want you to know that not all closing costs are deductible. So the ones that pertain to the actual transaction, we're talking about escrow fees, title fees, your exchange fees. If you needed an attorney to help you get through that closing, that's also deductible. Transfer tax. What's not deductible is your property taxes, because or rents. Anything that's prorated, those are not deductible. And those are usually a big expense. So technically you're using exchange funds to pay for those expenses, but technically that's technically boot to you. You're using exchange funds for a non-deductible expense. So I just want to be clear about that. The debt requirement. So if you paid off that loan at the closing of the sale, I mentioned that amount needs to be replaced in your replacement property. But you can always bring in money. You can bring in your own cash and offset that debt requirement. So if you paid off a loan on your investment property of $150,000, and you are looking at those interest rates, especially on an investment property, and you're like, that's not going to make any financial sense to me to take on this loan, and it's not going to produce the income that I need to cover that mortgage cost. You can bring in your own money to reduce that or offset that completely. So if you have $50,000 or $100,000 or $150,000 to completely wipe that clean, you can do that. It just means that you are bringing in that amount of money to that purchase transaction, and that offsets and meets that debt requirement. What you don't want to do is take on too large of a loan, and then you end up not reinvesting all of the netted proceeds that's being held in the bank account with me for you. So that is an important point to know about the debt requirement. And then, of course, the cash. So any amount of monies that's netted and held with me for you, that all needs to be reinvested into that investment property or spread amongst your different replacement properties. So back to that exchange timeline, it's very important to understand because it's defined. So there are no exceptions to this rule. So that first 45 days, like I mentioned before, is that identification window. And I can't stress this enough, because if you've never done an exchange, this is the most stressful part and most, hair-raising part of the exchange, is trying to find and nail down replacement property options within that 45-day window. So like I mentioned before, if you're not in contract, that means that you're providing me a letter of these properties that you think you're going to write an offer on. The letter can be interchanged up until that 45th day, midnight on that 45th day. But once that 45th day comes and goes, whatever's in the file with me is what you need to buy from. So there is no buying off of this identification list. You have to stick to it. It's imperative that you do that. So in my world, I'm firm on that. I will not relinquish and wire out funds if that property is not identified, because it's like tax fraud. It's like you knowingly are doing something that's fraudulent and going against the tax code. There might be other QIs who might be loose on that, but that is an absolute risk, a risk for you and definitely a risk for the QI. So I just want you to know that you really need to hone in on those investment properties by day 45. And then, so even if that 45th day falls on a weekend or a holiday, it doesn't matter. You can email that letter. It just needs to be dated and it needs to be signed, but it needs to be in my file, in my possession by day 45. Same thing with
probably the hardest thing right now, because inventory is so low, Megan. And so, and investors that I know, it's like they're holding investment properties and they're like, I want to sell it because I see opportunity, but it's very difficult to go make a contingent offer in a market where that's just really not acceptable unless the property's been sitting. And then even still, I think there's some extra added stress to that, because what if the transaction falls apart or whatnot? So what is your best advice for that quote unquote backup plan? Is that the DST or what is it?
Yeah, I mean, DSTs are readily available. So if you're in a bind, you can literally work with a broker who can find you an asset on day 45 and help you fill out that letter. They can do that. It's harder when it's in a residential or a commercial space because you don't know. You don't know if your offer is going to be accepted. But in the DST, or even with a tenant in common type of commercial real estate asset, you can work with that. So I would say that that's where the beauty is with those type of investments, is that you can do. Now, they're not the best, they might not be the best investments for you, but at least it's something that can get you further along in the exchange. And I should also mention that with the DSTs, they're not long-term. So we're talking about an average of maybe 7 years, long enough for some people if they don't like the asset. But it's not like a tenant in common property where the lease agreements that are in place is like a long-term. It's like a 15-20 year lease that you're trying to sign with that tenant. So your goal with those, and the longer you are in those type of investments, the more money that you make, because usually the value increases the longer the lease is over the course of time.
Can you identify multiple properties within that 45-day window?
I'm sorry?
Can you identify, like, can I have three options within that first 45 days that I email to you and say, I'm going to buy, I've identified this commercial property, I've identified this residential property, and I've then identified this DST as my 3 options? Or do I have multiple options? How many can I give to you?
Well, that's another slide, but I'll
Okay.
answer your question. So you do have options when it comes to putting together the identification letter. I will say the majority of people fall under this a 3 property rule. And that's the most common, because I think in the residential space, especially when there's limited inventory, it's really hard to find 3 solid investment properties that they know that they can write an offer on. So I think that's hard enough in the residential world. But I do stress that it is important. Please do at least more than 1 property. I literally just had a client who I was like, are you sure you're only going to invest or identify this 1 replacement property? She's like, that's all there is. That's all that's out there that makes sense for me. 45th day, 2 days after her 45th day, the deal fell apart. She's up a creek. So now she's done with her exchange. The money has to stay in the account until her 180th day expires. But if she had found some other investment property that she could have at least identified, it would have saved her. So it's the 3 property rule is there to have a backup plan, and you just list it by priority. Number 1 is the one I'm definitely writing an offer on. 2 or 3 is like, I can do that. I can make it work, but it's best to definitely fill that letter out and have a backup plan. When it comes to the 180-day, I just want to mention that what the 180-day is talking about closing on your purchase transaction. So if that 180-day falls on a weekend or a holiday, you better make sure that it closes before the weekend or that holiday. If it closes after, you've just screwed yourself. That means that you have a failed exchange. It didn't happen within your exchange timeline. And again, there are no extensions when it comes to these dates, except the only time that there's been extensions was with natural disasters. Natural disasters does not guarantee that you get that extension. So again, it's like you can't have that mindset because there was a flooding that I'm automatically going to get the extension. It doesn't necessarily work that way. So you want to make sure if that's the case, if somebody's involved in a natural disaster, that's part of your transaction, that you're working with your tax advisor to see that if that affects you or has any bearing on your 1031 exchange. So here we go with the identification guidelines. Like I said, most people fall within that 3 property rule. 3 properties. It doesn't matter the value on these 3 properties, whether the values are combined millions of dollars or individually there are millions of dollars. That doesn't matter. It just matters about how many. So if you want to identify more than 3 properties, then that rule no longer applies because you're choosing one of these 3 rules when you're putting together that letter. So if you're identifying more than 3 rules, the 3-property rule no longer applies to you. It's either the 200% rule or the 95% rule. And the 200% rule simply states, not simply because it gets complicated, but that you can identify more than 3 properties as long as the combined fair market value of the properties that you're listing does not exceed 200% on the value that you sold. So if you sold a property and your relinquished property is valued at $1 million, the combined values of the properties that you're listing cannot exceed $2 million. So now if you're identifying more than 3 properties, you need to start crunching numbers. So you need to see like, how much do all of these properties add up to? Because maybe I'm beyond 200%. So if you're beyond 200%, then that means you fall into this 95% rule, which is pretty erroneous because it says that you can identify more than 3 properties as long as you're acquiring at least 95% of what it is that you're identifying. So I do have some clients where they are buying multiple, they're basically diversifying or consolidating. They're consolidating all of their investment properties and they're putting everything into the DST space because it's passive income. They don't want to think about it anymore. They are done being landlords. They are probably diversifying and breaking it down and buying multiple different DSTs because they have different various rates of return. They don't want to put all of their eggs in a basket. And that might be where the 95% rule would work for them, right? Or because unless you know exactly that I am definitely buying all these properties, it's kind of I would say it's a crapshoot. So the 95% rule is probably the least common of these identification guidelines. So this is where the 1031 exchange can start to get a little complicated. But it happens quite often where people will be trying to consolidate their investment properties, but they want to keep them in one exchange file to reduce the cost. When it comes to multiple sale properties, it all boils down to timing. So if you have options, if you are trying to include multiple sale properties in one exchange file, then all of those exchange sale properties need to be closing within 45 days from the first one that closes. So if you have 3 sale properties, the first one that closes is what sets the time clock for that exchange file. The other 2 sales need to close within that first 45-day window. The reason is that you have to figure out how much value, how much debt, and how much cash do I need to replace to figure out how you're going to prepare that identification letter. So some people, they might be ready to list one property, the other property, it still needs to be fixed up, repaired, it's not ready. That probably, the timing's probably not going to work, if we're going to be honest. That's okay. That means that you would open a separate exchange file. So you would have 2 different exchange transactions. Now, the part where it can get really tricky is if those files are all going to funnel into one property. So you can do that. It now means like, okay, so with the exchange file A, if I have to replace the property value of at least $1 million, is the property that we're funneling into, does it have enough value for me to meet that requirement? Same thing with the debt and same thing with the cash. So basically file A would be purchasing a percentage of that asset. Same thing with property B. Would property B be able to buy the remainder of that valuation? The remainder, take on the remainder of that debt requirement, and would you have enough funds to reinvest for that remainder of that property? So if you're talking about multiple sales, the most streamlined way is to keep them all separated, and each one buys its own replacement property or multiple properties. When you start complicating it is when you start lumping them together, and that's when you're really like, your head is spinning about time frames and about requirements like the cash, the debt, and all of those things. So you have options. That's when it gets complicated. 1031, this is the part where I kind of get a little excited because there's many use. I call the 1031 exchange a strategy tool. I think there's many benefits to doing a 1031 exchange besides tax deferral. And, a 1031 exchange, it's forcing you to maintain this level where you're constantly buying up and up and up and up, which is a great thing because the first time you've ever done an exchange, you might have started small. You might have started with a condo, which is a great investment property. But now if it's forcing you to buy equal or greater, you're probably buying greater, but you're probably buying into an asset like a house that produces more income. So you're buying up, but you're also getting more out of it. So you're getting a greater income flow monthly, which is a bonus besides tax deferral, right? And so another way that you can use a 1031 exchange to help you is it can help you build up your real estate portfolio. You don't have to buy just into one property. You can buy into multiple properties. So if you had an asset of $500,000, you could buy two assets valued at $250,000. So now you have two sources of income in two locations, and so that's another great way that will help you diversify your portfolio. And like I mentioned, I always use this as like a visual tool. I feel like, or visualize a 1031 exchange as like a ladder. Each rung of the ladder is the next investment property. And so with the exchange is that technically you're always buying up and up and up. But I will say the first property that enters into the exchange, that's your basis, right? So when you first buy a property, that they call that your basis, that's what you bought into. And then any improvements that you make on that property increases the basis. So if you go and do an exchange, you're now buying a property, it's up here. So the difference in value is your taxable event. So if your basis started here and then you made the improvements, your basis reaches here. But if you were to sell this asset, your taxable event is from here to here. So, and then if you keep exchanging up, your basis keeps rising depending on how much of the tax you have deferred, because that also gets added to the basis. But if you're all the way, scoot back so you can see me, but if you're all the way up here and then you decide to sell, your taxable event can be absolutely significant because you've just been exchanging up and up and up over and over and over. But now if you buy up and then you buy multiple properties, you're buying out. So then that you can minimize that taxable event if you decide like, I'm going to sell this one asset, but I can still keep the others to keep exchanging. So the taxable event isn't from all the way up here and now it's out here. And maybe it's so minor that you have like depreciation or that you've used that can offset the gain. You have something that can help you offset the gain on that one sale transaction. So that's another way that you can really utilize a 1031 exchange to help you get to that point. 1031 exchanges, you can start switching it up. So I think a lot of people who are constantly in the residential realm don't realize how easy it is to invest in the commercial real world and vice versa. Like you can go back and forth. You can go from residential and go into commercial. You can come out of commercial and go into residential. So you can really switch up the type of real estate asset that, that works for you depending on where the real estate market is. So I think that's a benefit. And then the other one is that because it's a federal statute, you can cross state lines. So you can invest, you can cash out of California, which is uber expensive, and use those funds and go to the East Coast and buy up multiple properties with your exchange. I will say that there are states where they have certain provisions in place that are a bit nasty. Especially California and 3 others, they have this clawback provision. And the clawback provision is simply put where they'll allow you to cross state lines through a 1031 exchange. But if you sell that property and don't do an exchange, they're going to come back for you for the taxes that they feel is owed to them. So it's this nasty little clawback. And not every state does that, but because I'm in California, I know it well. California is definitely one of those states that tries to get it back. So again, it's important that you if you know this information, you ask your accountant, hey, what if we do a 1031 exchange and we buy in Texas? So what does that look like down the road if we were to do another exchange versus if we were just to sell it down the road? So it's important, again, to think long-term when you're dealing with that one exchange file.
Mm-hmm.
Another fantastic tool for 1031 exchanges is utilizing it for retirement, an estate planning tool. I have a lot of older mom and pop clients who are figuring out the next stage in life. And so they're thinking like, what if we consolidated our investment properties, but we bought something that ultimately we could retire in? Can we do that for a 1031 exchange? Absolutely. You can absolutely do that. You want to make sure, if that is your goal, you're definitely meeting that 1031 exchange requirement about holding the asset for long term. So if you're consolidating your properties into an exchange and you're buying that retirement home, make sure you're renting out that retirement home so it satisfies the 1031 exchange. After 2-3 years, however many years, you can convert it. By converting it from an investment property to a primary residence, it's not triggering any taxable event. You're just changing how you're reporting the use of that property. You're not transferring title. There's no taxable event that is being triggered by you doing that. So you're just letting the IRS know, we now are living in this property, we're not reporting any income. And that is absolutely okay to do that. So it's just another way to, if you have a plan, a 10-year plan, this can be part of your plan.
This is my favorite, probably one of my favorite things about the 1031 exchange, because people who are, aging out of their properties or have a plan in place, honest to God, this should be part of every financial advisor's plan with those people that are retiring. I mean, I think about this all the time for people. I think and I'm not an advisor. I just think it's a great way to, go into retirement with no debt. So,
right. Or what they do is they buy properties for their kids. So instead of like putting their money in a 529, they'll buy their kids these assets with the exchange funds to hold it set aside, and that can help pay for college education or what have you. So it's another way that they can plan for these type of life events.
Brilliant. All right.
Last but not least,
yeah, let's talk about
this is where I can really make your head spin. So there are other types of exchanges. The ones that we've been talking about, they're like standard forward exchanges or your typical deferred exchange. But when you're talking about an unstable real estate market, this is where these type of exchanges come into play. And they're known as reverse exchanges or improvement exchanges. And I will say that you need to be financially able to do these exchanges. So they're not for everybody. You just have that mindset. But the reverse exchange, I'll talk about that first. That comes into play when you are in an exchange, you have found your replacement property before you're ready to relinquish. You can't just go out and buy that property. Otherwise, you just have another asset under your name. So you can't exchange something that you already own, is my point. So in this scenario, I create an entity, an LLC, that is merely a shell. And you loan my LLC the money to hold title, to buy that asset and hold title for you. You and I have an agreement, a management agreement, where you're the property manager, and we have a promissory note in place that says, I will pay you back the money that you lent me to buy that property for you. So now I'm saying I, but it's my LLC. I'm sitting on title to the replacement property. Now you are able to go and sell your relinquished property like you normally would in a deferred exchange. You sell that directly to the buyer. We use the proceeds from that transaction that I'm holding for you as a QI to then buy the replacement property from my LLC. So it's kind of like this circular transaction. There's just an added leg to it. I will say that you have to be able to lend the LLC the money up front in order to buy that asset. We're not relying on the relinquished property, relying on sources outside of the exchange to buy that asset. Or you need to work with a lender who has this product, because it's not your typical conventional loan product. The loan needs to be in the name of the LLC, but it's guaranteed by you and your assets, and the property is still the recourse for the lender. So not every lending community has this type of property or product.
That is the key. Yes.
Exactly. And so there's that's the reverse exchange. And I will say that on average, reverse exchanges are much more costly. So for me, the average cost of a reverse exchange is around $6,000. And just so that you know, my exchange fee just in a deferred exchange varies. It's a tiered structure, but it starts from $850 and it goes up to $1,250. So we're talking about thousands of dollars of difference between a reverse exchange and a normal typical deferred exchange.
And also the lending side of it, it's a much more expensive loan product.
Right. Yes.
If you're not cash funding and the type of financing options that we, well, I mean, not every lender, but like we do specifically, they are more expensive financing options because you're leveraging it in a different perspective and it's a higher risk to the investor.
Right. And then some lenders will have like a minimum, like we won't do anything unless the loan is at least $1 million. So a lot of times it puts the client out of that and they just need to rethink whether the reverse exchange is really worth it. But really this conversation is for those who have the cash. You know, if you have the cash, then the reverse exchange is absolutely doable. It's very streamlined. It's just more steps, if you will. So, and improvement exchanges are in place because you have found a replacement property, but it's less than value. And you know that if you put in a little bit of elbow grease, that, you know, a couple of improvements, you could get that valuation. So it's set up like a reverse exchange where my LLC would initially acquire that fixer upper. And while I'm on title to the property, you are using funds to build up or improve that property. So while I'm on title, you're also selling, you can sell your relinquished property. And if you do that, you can use the exchange proceeds to make the improvements on the property. But all in all, it's set up just like a reverse exchange where once that relinquished property is done and once the improvements have been made, then you're purchasing that new, improved, revamped property from my LLC. You just need to know that the improvements have to be done within that 180-day time period. So we're not talking about a new development, a new project where you haven't even broken ground. I think we're talking about just revamping or rehabilitating a property that's already in place, like a new bathroom, new kitchen, something along those lines. So,
and a good contractor.
right. Well, that's the hardest part, right?
Yeah. This is how you guys can reach Megan. Megan, you are so knowledgeable and incredible, and I just truly appreciate your time today. I always learn something listening to you. I mean, I've heard this information before, but I always learn something new in these conversations. And I just thank you very much for always being a resource for me and for my clients. And anybody who has any exchange questions, I know I've sent Megan people, and I've learned now from listening to this again that some of the people I've sent to, it's like, nope, can't do that. But it's always good to talk to Megan because she's a great resource, and she might not know something that your lender, your realtor, your CPA might not know, right? So Megan's where you go. Thank you.
You know, I'm happy. No question is too big or too small. I will always take the time to respond or pick up the phone. So a lot of companies out there don't have that service, but I pride myself. Like, I just want to help everybody. That's just my nature. So yeah, reach out with any questions for me. Happy to help.
I appreciate you, Megan. Thank you so much.
Thanks.
All right, you guys, we're going to go on to assets as income. So this is kind of in line with some of the stuff that Megan talked about. You know, there's not a lot of traditional lending out here. A lot of lenders will tell you have to be of retirement age. That's actually not the case at all. So as a broker, I have access to multiple different types of investment products. And so I'm going to go through this briefly if you have questions, but you don't need traditional income at all. The rates that we have are super, super competitive on this with some of the investors we work with. It's for self-employed and non-self-employed borrowers, low closing costs, and all type of assets can be used in occupancy types and all type of properties. Bank statement loans, self-employed borrowers only. There's a 12-month and 24-month average. So if we're looking at depositories in a bank statement, we can use this if somebody like one of our investors doesn't have enough producing income on their federal tax returns. This is an amazing, amazing product to be able to step into and say, actually, you have tons of assets going into your business bank account. We just did this for our client who was actually purchasing an investment property. And they were denied by multiple lenders, came to us, we got it closed within, 3 weeks, and business income, our debt ratios were actually down to like 0.2% because of all of the money is going into the business. And this can also be stacked with other income. So if you have W-2 income, if you have 1099 income, if you're doing asset depletion or dissipation with your other assets, it's a great way. I would say stacked income is kind of my favorite thing to do because everybody else says no and we say yes. And this is assets with income. So depending on the asset, you can use 100% of the asset or 100% of the income. You don't have to be of retirement age. I know your other lender told you that. That's not the case. You do not need to be of retirement age to use your assets as income. You do not need to be self-employed. So as previously I said, oh, bank account income, that's different than assets as income. So we just look at your total value of your assets and we go through a dissipation or an accounting calculation and we come up with what your assets can be. This also can be stacked with other income, and this can be used for any type of purchase with any type of property, and also what your occupancy is. Let's talk a little bit about the feds really quickly. So this is just my quick update. So yes, inflation is too many dollars chasing too few goods. You know this, I talk about this all the time. I care a lot about inflation. The Fed's first line defense of inflation is raising the federal rate. We're probably going to hit the longest federal rate raise in the history of the United States by the end of this year. You know, we did believe the Feds would start cutting by June, but inflation's being very, 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 very stubborn. So I think that potentially the Feds are not going to raise the federal or drop the federal rate, excuse me, potentially until the end of this year, hopefully sooner. But again, it's all dependent on inflation. But if we really look at the inflation numbers, there was some commentary yesterday by some federal numbers saying that why inflation is being stubborn is because of broad measures. Well, like broad reasons. And actually, I disagree with that. And if you really drill down on the inflation numbers, like truly look at them, remember CPI is the consumer price index, and the Feds have this sort of, PCE is our favorite measure of inflation. But when you really, really look at the inflation numbers, we look at core. So core strips out food and energy. Energy prices are really high. There's a lot of reasons for that, internationally speaking, and various components are causing that. But if you strip out food and energy, because the Feds say they cannot influence that, they can't control the weather, which influences our food supply, and they cannot control various things that influences oil prices, et cetera. We look at the core numbers. Well, there's things in the core numbers that I believe the Feds cannot impact by raising the federal rate. So when they raise the federal rate, they're trying to push the inflation genie back in her bottle. And if we really look at the core CPI numbers for April, April actually went down. So we have a 3.62% year-over-year reading. The Feds have this 2% target rate. This is their rate, which now they're kind of retracting off of that 2%. Shelter is 5.53% year over year. Rents reporting on shelter lags significantly. We've talked about this before. It's kind of like being on a roller coaster. We're reporting back here, but really the numbers are down here. And motor vehicle insurance. Motor vehicle insurance is super, super, super expensive. Insurance is driving a lot of our inflation costs. And if you look at these two numbers, it actually accounts for 3.35% of the 3.62% year-over-year core CPI reading. That means that everything else has gone down to 0.27%. So it's not broad, it's actually very specific. Why is motor vehicle insurance expensive? Technology in these bumpers. Used to have steel bumpers, now you've got tons of technology all over it, and also theft. I'm pretty certain that the Feds can't raise the federal rate, and by raising the federal rate, that doesn't stop theft, and that also doesn't stop the technology in these bumpers and the replacement costs in them. Okay, let's look at this. So this is actually another breakdown of this slide here. This is this core CPI number. So if we're looking at the CPI index, you can see the car insurance here, and then you can see the shelter costs. Now, shelter's lagging. Remember, there's a lag effect in the reporting on CPI with shelter. I actually think they're going to redo these numbers again, because we were previously at 6.3, we're 6.7 in Q2, and actually interest rates went up over 7% again on some products, not everywhere, most lenders. So the national average is over 7%. So I think Fannie's missing the mark on this. But again, because of these inflation numbers, I think it's very difficult to do. Remember, inflation drives the bond market. Mortgage-backed securities reside in the bond market. this is the thing that like Megan was talking about in terms of inventory and how difficult it is. This is why. I read this article the other day and I almost fell out of my chair. This is the widest rate gap we have had in 25 years. 25 years. What that means is between mortgage rates on new loans and mortgage rates most mortgage holders have in the United States is the widest gap we've ever seen. So it has prevented 1.3 million home sales between Q2 of 2022 and Q4 of 2023. And this is from the Federal Housing Agency. So I always talk to people and I'm like, inventory is loan locked, right? We get into gridlock, we can't move. Inventory is loan locked, it's not moving. I have 3 calls today with past clients who are sitting at 2 to 3% who want to go buy something because their lifestyle has changed, because their family has changed, and they cannot afford it because of the higher interest rates. And if they were to sell, they would be downsizing actually, and they wouldn't be getting what they want. And so this is super, super important. And until we start to see mortgage rates come down, we're going to see really tight inventory, which ultimately drives up house prices. You're going to see a lot of data in the media about home sales. Actually, home sales were up. So I'll break that down probably next month. But existing home sales were up for the month of April, and the median home price was up year over year. There's a lot of reasons for this. They actually are saying, oh, we have so much more inventory. No, because they're accounting for on the inventory. If you read this in the headlines, they're accounting for dirt, lots that are available for sale. And dirt, as I'm pretty certain I wouldn't move into a pile, a raw piece of land with nothing. So when they say there's all this inventory for sale, they're putting dirt in there. The real numbers on inventory, actually houses for sale, we have under a 1.8 month supply of houses available on the market, nationally speaking. Nationally, I've already talked to you a lot about how we have all this pent up demand. There's a lot of people out there that want to buy a house and they just simply cannot. If you have questions on any of this, if you need to connect with Megan, if you have any questions for me, I'm happy to be a resource for you. I appreciate your time today again, Megan. Thank you so much. And thank you everybody who attended, and we'll be sending out this recording. And Megan, once again, my friend, you're just brilliant and I appreciate you.
Thank you. Likewise.
Have a great day. Bye.